Welcome, traders. Welcome, traders. Boom. Welcome to another live Q&A session with Oliver Velez. Of course, as you know, my name is Oliver Velez, and there's something I don't want you to forget. I am your trader for life. That's right. Right here on YouTube. Now, traders, as you know, I try my very best to do our live Q&A sessions on a very regular schedule. The normal schedule is Mondays at 2 p.m. Eastern Time. That's New York time. And because of my travel schedule and because of some of my event schedules, I'm not always able to hold dear to that schedule. So there will typically be two alternatives. The second alternative is Wednesday, and the third alternative is Friday. So here we are at 2 p.m. Eastern Time on a Friday, exercising the third option of the week. I will do my very best not to really miss a week, but I will be doing it either on a Monday, Wednesday, or Friday. I want to thank you for being loyal to this segment of my YouTube trading channel. I want to thank you for taking the time out to send me your questions, as some of you are increasingly beginning to send those questions to me on Twitter, which I told you I will place the first priority on those questions that come to me via Twitter. It's primarily the only social network that is 100% controlled by me. That doesn't mean that the other social networks aren't great. I do spend time on all of them. It's just that on Twitter, my team does not have control of my Twitter account, and so therefore it's 100% me. And so therefore any individual who obviously takes the time out to not only follow me there, but to ask their questions there, I'm going to go there first. And then, of course, I'll always be able to take some of your questions that I see streaming live in front of me right now. All right. So I am looking forward to this. It's been a phenomenal week, guys. It's been a very exciting week on a lot of different fronts. It's been a power-packed week. It's been an extraordinarily profitable week for my traders and me. So, excuse me, we're sort of closing out the game here today on a very nice high note. And I'm hoping, if you're not one of my traders, that that's been the same for you. All right, so what I really want to do, traders, if I can, is take the first few questions here from my Twitter account. If you'll allow me very quickly here to grab them. All right, now the first question that I'm seeing here from Billie Jean is, Oliver, I love you. Thank you very much for what you do. I appreciate that. How does interest rates and inflation influence, if at all, the bond market? I'm confused. All right. I think it's important to understand, if you are or want to be a serious financial person, you want to be a serious trader, you want to be a serious speculator or player of financial markets, you have to understand the bond market. The bond market is by far, outside of the forex or the currency market, the largest market of all markets. Now, what's interesting to understand about the bond market is that it is considered to be the most intelligent market of all markets. That's right. Listen to me carefully, traders. The bond market is considered to be at the top of the food chain as far as intelligence is concerned. So bond traders are considered to be smarter than all other types of traders. The bond market as a whole is supposed to be better at reading economic trends, where we are in the overall economic cycle. Bond markets are considered to be better at anticipating what is going to happen throughout all of the markets as well. It sits at the top of the food chain. In fact, this has been the case so long, traders, that it was taboo to be an equity trader. When I first got into equities, right, trading the stock market, it was still a bond person's world. The saying went on Wall Street, bonds are for gentlemen, and trading equities, well, not so gentlemanly like. Now, this took a shift and a turn to a certain extent in the mid to late 1980s, and especially as we moved into the 1990s. But for decade upon decade, it was considered to be more sophisticated, more aristocratic to be to be involved in bonds. So that's very important. If you don't understand the bond market, I think it might be a good idea to just start educating yourself on, the bond market and yield curves in particular. Bond yield curves should be understood by every serious market player. And of course, you can probably search some interesting things right here on YouTube. Bond yield curves, okay? Inverted curves and things of that nature are very important signals for the market. The main thing I would say that is important to understand is that falling interest rates, all right, create a bull market in bonds. So bonds operate inversely to interest rates. So if interest rates decline, bond prices rise. Okay? If interest rates rise, bond prices collapse. So it's an inverse relationship to interest rates. This is very important to understand. It is arguably, we have been in a 300-year bond market bull. We have been in a 300-year bull market. So I want you to think of 300 years ago where it was common for someone to charge you 100% interest. So look, I'll invest in your project, but I have to make double. That's like 100%, right? Interest. It was very common, but 100% interest became 80% interest, became 50% interest, became 30% interest. Now remember, as interest rates drop, bond prices go up. So bond prices are rising while interest rates commonly at 100% drop to 80%. All right. Any bond that was yielding 100% would go up in price because now bonds offer 80%. So of course, the bonds that are offering 100% are going to be more valuable than the bonds offering 80%. And if the interest rate drops at 50%, the bonds that are offering 80% returns are more valuable than the bonds offering 50%. So they go up in price and so forth and so on. Well, where have interest rates gone over the past 300 years? From 100% to where? To zero. 0%. Guys, look, Google this for me. As a matter of fact, let me try to show it to you. I'm going to show this to you. I'm going to search for it. This would be cool, right? Right? So interest rates have gone from hundreds of percent, right, down to zero. Guys, if you don't, like, there are bonds, right, that have been issued with a 0% coupon, which means that you give me $1 billion for the next 5 years, and I will give you zero interest back. I will just give you your $1 billion back. Now, you would ask that, why would someone do that? Why would a company do that? Why would an institution do that? Well, 2 reasons. Number one, they might have a mandate to have a certain percentage of their portfolio in bonds, and there's nothing they can do about it. All right? That's one reason. Another reason is that they could believe that just maintaining their purchasing power is going to be better over the next 5 years because environments might cause purchasing power to be debased at a much more rapid rate. And so that would be a win in that case. But I don't want to wax too complicated here. That's the main thing I want most people to understand, is that declining interest rates cause bond markets to rise, rising interest rates cause bond prices to decline. And so this whole bond markets have been collapsing as of late because of the Federal Reserve's more hawkish stance, and of course their hike in interest rates, 25 basis points, with the expectation of maybe 6 more coming down the lines. So bonds are having a very, very difficult time in this particular environment. And so those are the main things I do want you to understand. But just to give you a general idea here, guys, if I can do this, I want to show you something here. Take a look at this. Boom. Warren Buffett borrows $77 billion for free. Look at it. How Warren Buffett borrows he's borrowing. When you're borrowing, you're using the bond market. All right. Interest 77.2. Look at this here. $77.2 billion interest-free loan to Warren Buffett's Berkshire Hathaway. And so this is what's called the Catillion Effect, right? When the powerful and the wealthy, usually in the form of their institutions, their corporations, are closest to the money printer. So $77 billion gets printed out of thin air and given to Warren Buffett for absolutely zero. Now, this is the Catillion Effect, where those who are closest to the money printer gain access to free money. But you and I are not close to the money printer, so we gain access to capital at 11%, at 15%, at 12%, and if we're lucky, at 8%. But Warren Buffett benefits from the Catillion Effect. He can borrow at 0%, and he did loans at negative 5%. This is a great one at 0%. He's done loans at negative 5%, which means that you give me $1 billion, I give you less than $1 billion back in 5 years. It's literally crazy. And so the world has largely been run by the bond market. And the equity market is the little tiny baby cousin that basically responds to a lot of things that the big cousin, the bond market, is doing. Do you understand? And so this is very important to understand, traders. And by monitoring the bond market and where those yield curves are, where interest rates are, can really give you key insights into where the baby market that typically takes its cues from its bigger cousin, the bond market, is going to go. So bonds signaled the market sell-off early. Do you understand? The bond market signaled the entire market's collapse over the last couple of months. It was the first signal of all. All right, now, a lot of traders have to focus on just getting their trading under control first before you start venturing into the macroeconomic aspect of the market that can give your trading an edge. But you can't give bad trading an edge. You understand? So you don't focus on the macro things like bonds before you get your trading under control. You need your trading under control first. And then you can start moving into understanding the macro elements that can affect the flow of the market that you trade. All right, so good question there, by the way, good question. All right, let's go to the moon. The moon is saying, Oliver, what kind of annual returns do you consider as good? And could you please share your views on systematic trading? That is completely rule-based trading with no discretion at all. Okay, that's 2 questions, by the way, by the moon. Okay, first question, what kind of annual returns do you consider to be good? It depends on what style of market play you're talking about, because if you're talking about a short-term day trading like style of market play, those returns are high. In fact, day traders don't look at returns because they're often trading with excessive amounts of leverage, and the return numbers just look ridiculous. So let me give you an example. A professional trader might have leverage as high as 100 to 1. So meaning $1 million can get the trader $100 million of trading. All right. And if I make off of the $100 million, if I make $1 million, I really made 100%. All right. Not 1%. So it's 1% based on my leveraged amount. 100 million is my leveraged amount. But my cash amount, the real money at risk, is the $1 million. And so I'm using $100 million to make $1 million, but that $1 million is 100% of the cash amount that I have in the play or in my portfolio. So in reality, I made 100%, not 1%. And so short-term oriented traders tend to use dollar amounts and not percentage amounts. All right. A trader can double his account in a single day if he's highly leveraged. All right. Now, if you are talking about longer-term play, let me throw some interesting numbers out to you. We just talked about Warren Buffett's borrowing money for free. Let's talk about the fact that Warren Buffett has become the most recognized, the most hailed, the most focused on, and the wealthiest professional market participant the world has ever known. He's done that with an average annual return over the past 40 years of about 15%. I'm going to repeat that. Warren Buffett became the wealthiest investor ever known to mankind with an averaged annual return of about 15%. So there you go. Now, it should be noted that Warren Buffett is playing with hundreds and hundreds of billions of dollars. And so 15% on that amount is truly impressive. And the consistency over time is even more impressive. Okay? An individual player should trounce Warren Buffett. As a general, as just to give you an idea, my wealth program, my wealth trading program has had annual returns of over 300% for the past decade. That's annual, over 300% for the past decade. Do you understand? An individual should be able to trounce Warren Buffett's record. That doesn't take anything away from Warren Buffett. It's just that the individual trader, the individual investor has the benefit of being more nimble. All right. We can be more nimble than Warren Buffett. We don't have to buy 88 million shares over the next seven months. We can buy right now. And for Warren Buffett to unwind a position and to do it without the world knowing has to take time. We don't need to take time. We can get in and out. And so our precision is sort of like that little speedboat versus Warren Buffett's Titanic trying to turn this slow, big, giant, clunky machine around and maneuver. Now, size has benefits, but it also has disadvantages. Our size has benefits, more nimble, but it has disadvantages too, where we can't push things around like Warren Buffett can. We can't influence things like Warren Buffett can. So I know I'm long-winded with this, but what is a good return? Listen, if you're beating Warren Buffett, you're doing okay. Now, let's understand some numbers here. Over the past 10 years, over the past several decades, the annual return, several decades now, the annual return of the S&P has been about 11% with dividends included. That's important to understand. Not just the pure movement of the S&P 500. It includes dividends, or it assumes that all dividends paid are actually reinvested into the stocks themselves. So it gets to 11% over the past several decades with dividends included in the play, in your overall play over the past several decades. If you take dividends out, you're roughly around 7-8%. So 7-8% annualized return for the S&P 500 over decades without dividends, about 11% with dividends. All right, maybe it's a little higher, 8-9% without, 11% with. Now, NASDAQ has been a little higher, about 14%. All right, so 14% annualized over the past several decades. Now, over the past decade, those numbers have jumped up. So we've jumped up to about 15% on the S&P because of money printing over the past decade has accelerated. And because of money printing by the Federal Reserve having accelerated, the NASDAQ has jumped closer to 18%. So you've got 14, 15 to now 18%. And those are what the new numbers are. So right now, in today's environment, if you're roughly doing 20%, you are beating the market. And that's the threshold, is to beat the market. Because if you're not going to beat the market, then what are you doing? You might as well just buy the market. If you're going to underperform the S&P 500, why not just buy the S&P 500? If the S&P 500 consistently beats you, you should not be trying to do anything other than get yourself into the S&P 500. If you're not beating the NASDAQ 100, then why are you individual stock picking? Just buy the NASDAQ 100 and be done with it, right? So those are always going to be your thresholds for market play. Can you beat the market? Now, when you get into the cryptocurrency field, right? Bitcoin being the king of all cryptocurrencies, being the only cryptocurrency as far as I'm concerned. Everything else is a technology project. So Bitcoin has two numbers I think it's important for everyone to understand. It has the KGRA number, which is roughly about 213% a year. So if we go all the way back to the beginning of Bitcoin's life, Bitcoin has basically a cumulative average annual growth rate of 213% a year. There is no asset that has ever existed in the history of life, in the history of the world. Not on this planet. I don't know about other planets yet, but this planet, no. Bitcoin, 213% a year, trounces. The next one is the NASDAQ, which I told you is now at about 17, 18% a year. So 213%, 18% a year, there's no comparison, right? We've never had an asset class do this before. You understand? But the other number I think I need you to understand is the fact that it's a little unfair to use the very beginning years for Bitcoin because Bitcoin traded at zero. So if you go up even a fraction of a penny, that's 1,000%, or that's 100%. You know, so counting those early numbers skews the number really big. So if you just take the last 10 years, so we take 3 years off, right? Let's take the beginning 3 years out of the numbers. We're looking at 140% a year. Then that's first place, 140%. Second place is the NASDAQ, 17%. 17%, 140%. 17%, 140%. Guys, this is in a completely different galaxy. Now, you don't buy anything else except Bitcoin unless you think you can beat 140% a year. And if you can't beat 140% a year consistently, then what the heck are you doing? Just buy Bitcoin. If you can't beat these metrics, if you can't beat the standard, just buy the standard. That's investment trading economics 101. You only play individually yourself if you have the capability of beating the standard. If you don't, just freaking buy the standard and go to the beach. You follow what I'm saying? All right, cool. All right, good. All right, good questions. The second part of the Moon's question was, what about systematic trading? I think what the Moon is talking about is algorithmic trading, trading without any human intervention. Now, interestingly enough, I've had as many as 14 algorithmic trading systems operating in the markets without any human intervention. This is going back going all the way back to the mid 2000s. And some of my algorithmic trading programs were largely focused on trading the NASDAQ market, in particular for rebates. And I don't want to get into what's trading for rebates, but literally we were doing about 1 billion shares a month trading for rebates, just algorithmically, trading between the pennies and things of that nature. These things require constant programming, staying on top of things. Environments change today so rapidly that your code has to constantly be tweaked, constantly be changed. You have to constantly monitor things. And quite frankly, over time, the inefficiencies basically just got, for me, basically just started to become commoditized. Those inefficiencies that I was taking, that my algorithms were taking advantage of, just got smaller and smaller and smaller and smaller. And so it stopped being worth it for me. Now, one of the main questions I get about algorithmic trading is, will programmatic or robotic or algorithmic trading one day take over the individual? And I would say no. But what I do believe is that they will be merged. So 100% algorithmic, no. 100% human, no. And in the very same fashion, traders, where we are as human beings, we are already part cyborg. We are already part robot. All right? We're already living like a Terminator. You see, this is the merging of superhuman capability, which I carry with me virtually every moment of the day. And so it can arguably be said that I am smarter with this in my hand than I am with it not in my hand. See, with it in my hand, if you ask me something I don't know, I probably can quickly search and get the answer for you. But without this, I just have to be left unknown. So that makes me part cyborg. I'm not using 100% of my human capacity. I am using human capacity with technological capacity as well. And together, I am me. And so trading is going to follow the same route, where your trading platform is going to continually gain the ability to present greater opportunities to you that you wouldn't be able to find or see or recognize without it. And that is becoming part algorithmic in your trading, part machine in your trading, and still maintaining the human element. Now, the human element is important to maintain, traders, because at the end of the day, even the algorithms are made by human beings. So what's baked into them is the human psychological elements of fear and greed. And if you lose touch with that, you lose your feel for how markets really operate. So you never want to go 100% technical, 100% machine. I leave myself out, because the problem with a 100% mechanical system, its benefit is actually its Achilles heel as well, because it cannot reason when a rule should be broken. Rules are great, and traders are great at breaking rules. That's why they lose a lot, right? They lose a lot because they can't be as robotic as your algorithmic trading platforms typically can be. So that is the human's fault, and that is the machine's strength. But what the human's fault allows the human to do is to identify exceptions to when the rule should be broken. Exceptions to the rule. And so My mother taught me, Oliver, cross at the green. Go all the way to the corner and cross at the green when I was a little kid. Don't cross in between the street. It's very dangerous. Walk all the way to the corner, wait for the green, and cross at the green, not in between. Cross at the green, Oliver, not in between. But there are times when it's smarter to cross in between. You know? And a human has the capability of reasoning the exception, and the machine can't. It will just go to the corner and cross at the green every single time. Wait a minute. My son just ran out into the middle of the street. Wait a minute. What would the machine do? Go all the way to the corner, wait for the green, cross, and then go all the way back. Whereas the parent would dash out and save the kid, right? That's why you never want to eliminate the human side of things, because of the human's ability to say, you know what? Not this time. But when you can combine them both, wow, it's very powerful. All right. I hope that is clear. All right. We're rocking, guys. All right, I like this question by, I hope I'm not butchering this name, Ariesh Patil. Okay. Hey, Coach. Will the 92% failure rate ever change in trading? Such a fascinating question. Such a fascinating question. I used to believe it would. I worked on changing. It was my goal to change the failure rate. That is why I got into the educational space all the way back in 1993. I started my first educational firm in 1994. All right. And I was out to do this for institutions first, right? So my pitch was, I'm going to change the failure rate, because institutional firms would run 100 people through and know they're going to get like 10 at most out of the 100. And they'd fire the 90, fire the 92, fire the 94. And boom, okay, and they throw 100 people again and know that over time, 90 is going away. And so that's how they grew their team, by growing the 10, growing the 6 to 10 out of 100, repeat. 6 to 10 out of 100, repeat. So I sold them on the idea that I could change that failure rate. And so institutions sent me their traders at a price of $25,000 per trader for 1 week, and they would send me 10 at a time. I took 10 traders every single week at $25,000 a head for 12 years. Crazy, right? Anyway, did I change the freaking number? No, I didn't. I failed. Now, I didn't fail at creating some phenomenal traders. I just freaking failed at the 92%. I just realized you can't change this number. Just like you can't change the general 80-20 rule in life, right? You want to know what the truth is in almost anything, apply the 80-20 rule. Well, in trading, it's the 90-10 rule, or the 92-8 rule. We can round 90-10 rule in trading, but in life, it's the 80-20 rule. All right? And it just can't be changed. It's baked into the psychology of the human. It's baked into the DNA. And the reason you can't change this is because how long has fear and greed been with the human species? Forever. And the only way that can be changed is if we finally find a way to change the human fear greed cycle. And this is what creates boom and bust cycles in the economy. This is what creates booms and busts in our relationships. This is what creates high points and low points in our life. And this is what creates the rise of empires and the fall of empires. It's just baked into everything. And so, no, I don't believe that you can change it. I do believe that individually, You can change the odds of which side you fall on. So I don't want that to be discouraging for you. I am talking about in mass, all right? In mass, in group. I'm talking group talk, mass talk here. Individually, you can change the odds of whether you're an 8%er or a 92%er. Now, one last thing I'm going to say about this statistic. 92% of the people will not be able to do this for a living. But that's not to say that they can't become decent market participants. Doing it for a living is different from being a decent market participant. Like Warren Buffett would be the 8%. He would not be the 8%. Warren Buffett will be a 92%er. I guarantee you. He would be a horrible, horrible trader for income day to day. But that doesn't stop him from being a great investor. Do you understand? So when I say 92%, I'm specifically talking about doing this for a living and you need nothing else to survive. That's what I'm talking about. You want to start broadening the scope and stepping back a little bit, the numbers are very different. You know what I'm saying? They improve. And think about it. Of course, the more time you give yourself between actions, the greater the odds that you refrain from doing something stupid. I mean, the time stops you from doing. In the short term, you can do a lot of things stupid in a very short period of time. In the long term, your actions don't happen that frequently, so you can't do a lot of stupid things. You know what I mean? All right. What else here? Okay, this is a good one. Heartbreak Yoda. Like these names, guys. Hi, Oliver. How long do you think it takes to really understand price action to the point where you're profitable? Dude, that's my question to you. Like, how long is it going to take you to do the right thing? How long is it going to take you to understand what you're supposed to understand? How long is it going to take you to stop doing stupid things? How long is it going to take you to do what you already know you should do? How long is it going to take you to be able to follow a plan? You understand what I'm saying? Like, none of these things are in my power. They're all in your power. You can know. Here's the statement that sums everything up. Knowing what to do is no guarantee that you do it. Now, I'm an expert, ladies and gentlemen, at teaching you what to know. What I can't do is make you do it. So when you come to me, it's a partnership, right? I'm responsible for pouring all of my experience into you, and I do that exceptionally well. But I can't press your buttons for you. Do you understand what I'm saying? I can't do that. I can't make your decisions for you. I can't make your buys. I can't make your sells. That is you. And so these are questions I really can't answer. Everyone's different. This is a random walk for virtually every single person who steps foot on this journey. Everyone brings a different set of psychological baggage to the table. Everyone brings their own individually shaped past, their tendencies, their habits, their idiosyncrasies. Their personality is different. Their intelligence levels are different. Their physical skills are different. Their ability to conceptualize is different. Some people think excessively more than others. They're going to have a harder time than the person who doesn't think that much at all. So it's so individual that it's very difficult. But with that being said, I'm going to give you some guidelines anyway. I will tell you that it took me 6 years, more or less, to turn the corner. Do you need 6 years today? No. But that was with no one. Okay? No guidance, no anything. A lot of trial and error. Trial and error is going to be the longest path you ever take in this. And the most expensive, by the way. I would say, but at the same time, I would say you should be willing to give yourself 6 years. Not 6 years to make money. 6 years to really have it. See, you can start making money before you really have it, traders. Before you really perfect it. You know, just like there are different levels of basketball players in the professional basketball league, right? You've got some that are at the top of the chain and some that you don't really hear about a lot, but they're still in the pros. They might sit on the bench most of the time, but they're gaining the minimum salary as a pro basketball player. You know, and those are the names that aren't on TV very often, but they're still pros. And so they're still making $300,000 a year or $1 million a year, right? But you hear about the people making $150 million contracts, but not the guys making $500,000. But they're still making. So if we apply that analogy to trading, you may not be a superstar, but you might be able to pull out $500 a day, $1,000 a day. That's not superstar stuff, right? And you're still progressing, you're still growing. You still make mistakes. So don't think I'm saying that if it takes you 6 years, I'm saying 6 years to really have it locked in. That's very different. You'll probably start making money before that 6-year point. The reason why I say you should be willing to give it this period of time, because look, guys, what in life can you truly master in a month? What worthwhile can you master in a month, in 3 months? What worthwhile thing in life can you master in a year? I've said this before in one of my Q&A sessions. You can't even get a frickin' rinky-dink Fred Flintstone college degree from, you know, the trashy college, you know, community college on your corner. You can't even get a nail salon certificate in less than a frickin' year, right? Like, and that doesn't even make you a master at doing nails. So my point is that you should be realistic about this. If you're going for mastery, it's not going to happen now. Nothing in the realm of mastery happens now. All right? It's going to take time. It's going to take years, but you can see progress along the way to that mastery. You understand? 18 months is probably the fastest I've seen. 18 months is probably, and I've been teaching for almost 30 years. 18 months is probably the fastest I've seen. 20 years, maybe something like 18, 20 years, the longest. Yes, I know someone who was trying to get this for 18, 20 years and they finally got it. They just never stopped. All right. Let's see here. Oliver, this is a good question from John Costello. Oliver, does the 6-year period begin with the first day that you start trading to trade? Such a great question, John. I'm so glad you asked that, because your questions allow me to bring some nuances out here, traders. No, it does not start from the day you start trading like a freaking idiot. Do you understand? No, that's not what we're talking about. We're talking about when you sit down and finally methodically start approaching the market with a method, with a plan, taking notes, journaling, doing what you do as a professional to get where you want to go. Not just waking up, let's see if we can get a winning trade here today. Let's see if we can get a winning trade here today. Boing! Like, come on. That's not what we're talking about. You're never going to grow from there, right? You can't wake up every morning and just hope that great trades start happening. It doesn't happen that way. And so the people who are doing that with no work in between, these people are not, they haven't even gotten to the starting line yet. In fact, many of them are developing what I call negative experience because they're reinforcing bad things that make it take them back further and further and further away from the starting line. And so they might need years just to get back to square one, which is zero. Okay? So you got to be careful how you start here, guys, because you can bake certain things in your trader DNA that virtually makes it impossible to remove. And you're making your progress in the future harder by reinforcing things. I get this all the time. Traders say, Oliver, man, I love your stuff, your information, your knowledge has changed my life, man. And when I start making money, I'm coming to you to learn. What? Wait. When you start making money, then you're going to come to me to learn? Like, dude, your world is backwards, right? It doesn't work that way. First of all, if you start making money, don't come to me. All right? Don't mess anything up. Just keep that going. All right? But, you know, you as an untrained trader can't find money to then start getting trained. That it doesn't, you have to get trained first, and you have to become a better version of who you are now, and that better version starts making money. But you can't be who you are now, make money, and then say, now I want to train, unless you're really just understanding that I'm going to freaking gamble my way to Oliver Velez. I know I don't know squat, but I'm just going to gamble my money, and if it hits, I'm going to Oliver. All right, well, if that's what you consciously understand, fine. But don't go out there and think that you're going to take your little tiny baby little money, not being trained, not being educated. I'm going to go make a fortune, and then I'm going to go to Oliver to learn how to make a bigger fortune. It doesn't work like that. I mean, in Disney movies maybe, but not in this movie called the stock market. It doesn't work that way. You're going to make a donation to someone. That's exactly what's going to happen. All right, there are two types of market players in this world. Those that donate or deposit into their account. Anytime you put money into a trading account, you are making a donation to someone else. I promise you. I have numbers on my side. 92% of you are making a deposit to some other trader or some other group of traders. You open up a trading account on Robinhood, that's a donation. 92% of you, you're donating. I say put your money away. Use mine, and let's do this the right way. Do you understand? Stop donating to other traders. Stop donating to the market. Professional traders only withdraw. They don't donate. They withdraw donations. So you're either going to be a withdrawer or you're going to be a constant donator to someone else. You decide. All right. And like anything else, guys, you wouldn't want to send your parents who needed medical attention to someone who says, yeah, I'm a doctor. I can operate on your parents. I did it myself. I learned how to be a doctor myself. Really? Yeah, I can operate on that. I watched a few YouTube videos on this. Really? Seriously. Yeah, I can try your case. You're on trial for murder? I got this, man. You know how many lawyer movies I've watched over the past 10 years? I've got you. Really? Same thing here, guys. All of that sounds silly, right? But for some reason, people lose their common sense when it comes to the market and say, I can do it myself. How? How is that? Like, not today. That's not going to happen. Not today. Not going to happen. All right. Hi, Oliver. Surya is saying, hi, Oliver. Back testing works for many strategies, but the mindset is not the same in real time. how to manage and control psychology and stick to the rules. It's very true. When you look back in the past and you see so many things work, that's not to say that has zero importance. It has an importance. It's a confidence builder in what you're going to apply in the future. So if you find something that has a decent rate of reliability in the past, this gives you the confidence to now try it in the real, okay, going forward. So that's the purpose of looking back in the past, to determine what you're going to try. Keyword try. It still might not work for you. So you try this. Now, you should always have a set of rules sitting in front of you, staring at you. So how are you going to play this thing? What are the entry rules? What's the initial stop rules? What's your profit-taking rule? Or are you just going to try it and then do everything by the seat of your pants? I think I should take profits here. Oh my God, my profits are disappearing. Let me snatch them now before they disappear. Like, that's not trading. Everything needs to be rule-based. And so if you can't write your whole all of your trading rules inside of 8 lines, I'd give you 10 lines. 10-line trading rule. If it's not 10 lines or less, it's too freaking complicated. It's too convoluted. You're barking up the wrong tree. So basic trading rules. How are you going to protect yourself? What's the rule to adjust that protection? What's the rule for taking profits? How specifically are you supposed to enter? What's your size rules? So how do you know what size to go into this particular play with? What are the rules surrounding that? All right. What are the rules for selling half versus selling all of the play, or selling 1/3? Is that something you pull out of a freaking hat, or should be rule based? Oh, wait a minute. This is one of those scenarios where I take half the gains, not all the gains. What's your re-entry rule? How do you know if a stock kicks you off, whether the stock should be bought right back again? What's the rule that determines that this one is a re-entry and this one isn't? If you're not trading like that, you're a gambler and you're a donator. Now, donations are cool. I mean, that's how we support ourselves, right? If we don't have donators, we don't earn our living. So hail to all the donators out there. But if you're my follower, I don't want you to donate. All right? That's the only thing. We need donations. We need the donators. The donors, I should say. But I don't want you to be that if you're mine. Do you understand? All right, guys. How long? All right. In 10 lines. That's right. You want... Dennis D is saying 3 years worth of rules in 10 lines. No. There's only 7 parts of a trade, and you should have a line for each trade. Each part of a trade. There's the entry. All right. There's the stop. There's the profit taking part. There's the stop adjustment part. There's the add part. Like, guys, it's not rocket science. There's only like 5 to 7 things you do every single trade. Have a rule for each one of those. And this is what we break down with my traders, guys. They're specifically rule based. All right? They're specifically rule based. Let me show you rule based, guys, if I can. I'm going to show you rule based trading. All right? I will show you rule based trading. Shall I? Yes, I shall show you rule-based trading right now. Boom, boom. There we go. Now, this is a trader of mine. I hope she doesn't mind me sharing her name. Her name is Sophie. Okay? I hope Sophie doesn't get angry with me about this. But I did post this on my Instagram channel the other day. And as you can see here, look at this. Just look at how professional this is. All right? Look at the precision. If you look at every single move here, traders, you can almost feel that there is no guessing. There's not a single guess. You don't even have to know, Sophie. You can look at each action and say, wow, that was specific. Wow, that entry was specific. Wow, that exit was specific. That add was specific. This is rule-based trading. When you see all of these actions, you know that's a professional at work. That's not someone saying, oh my God, I hope this works. Let's see if this one works. Like, that's not the type of trading that's taking place here. Do you understand, traders? This is these are trained actions that there's no doubt or hesitation at the moment a specific action is required. And so you can see, follow the numbers. You can see one, she's entering, where she's entering. All right. 2, where she's adding. All right. 3, where she's adding. 4, where she's got them even freaking color coded. Green, where she's taking profits on 4. All right. And 5, 6 taking profits. Look at her adjusting her stop. Look at number 5, adjusting the stop down to the pivot. Then adjusting the stop down to number 7, the pivot. Adjusting the stop to the next pivot, 8. Look at her final stop out at 10. Sophie grabbed the entire frickin' move. She milked this cow. This cow was like, I don't know what a cow weighs, a ton. And now the cow's skinny. At number 10, she milked all the milk from the cow. All of it. There's no milk left. Right? Sorry. I love this. And these are the things this is how to play the game, traders. Do you understand what I'm saying? And so the trading world is always going to be divided into these two groups, right? Those who do no work in between their trades, those who just roll from one trade to the next, hoping somehow magically that this new trade is going to magically be different when they're the same. That's one group, that's the big group. And those who put the work in, and they use every trade as a stepping stone to the next trade. Do you understand? That they are not the same trader that they were on this trade from the last trade. That they have been, it might be imperceptible to the eye, they've been changed just a little bit by this trade. They put the work in. They trade with method. They trade with strategy. And they're not governed by their thoughts. They're not governed by their feelings. They're not governed by their beliefs, because your thoughts are your number one enemy. Your thoughts in your trading betray you. Your feelings betray you. Your beliefs betray you. What doesn't betray you is the freaking trading plan on the piece of paper, because that trading plan doesn't have a single thought, doesn't have a feeling, doesn't have an emotion, doesn't have a belief. And it never wavers. It's the same every single time. If you don't do your trades the same every single time, how do you expect to be consistent? Because consistency comes from doing something consistently. Consistency begets consistency. But if every single trade is different, how can consistency come from that? It's impossible. It can't. So the first thing you've got to do is lock down a method that makes you do every single trade the same way. Like a robot. And later, as you develop, you can start wondering about what are the exceptions, but not in the beginning. No exceptions in the beginning. You're 100% robotic in the beginning. And you build your, someone asked me, Oliver, when does my experience start? Right here. When you have something that makes you do every single trade the same way, every single time, your experience starts that day. And then being a robot for 18 months, 2 years, will basically help you grow to the point where, you know what? I'm noticing that this is an exception to this robotic move right here. Your own experience starts to become your teacher. A lot of people say, Oliver, I want you to be my mentor. I want you to be my teacher. I am really not your ultimate teacher. I'm not your ultimate mentor. I am the guide to your ultimate mentor, which is your experience. But at the period where you don't have experience, my job is to stop you from blowing up. My job is to stop you from going down an 8-year dead end. My job is to stop you from losing every single penny you have so that you can't do this anymore. My job is to help you last until your experience gets big enough to, boom, experience grows to the point where it says, Oliver, I've got it from here. I am your guide. I am your Moses. Do you understand? I can't take you all the way to the promised land, but I can take you to the mountain. All right? And that's my job. All right, guys. All right, guys, I love you to death, man. These things are fun. Fun. What you guys help me do is bring out these little nuances in these broad messages. All right. And that's why I love these sessions so much. And I love your questions, guys. Many of them are very pointed. I want to thank you for your support. I want to thank you for constantly being here. I want to thank you for taking in the content every single day. Truly, it will be life-changing for you. I truly believe this. So if you have not yet subscribed to the channel, guys, please subscribe. I want you to click the bell in the upper right-hand corner. I think that's over here for you. And make sure you have all notifications on so that every time I go live, every time I have a piece of content, you don't miss it, okay? Follow me on Twitter. Follow me on Instagram. Follow me on my social networks, guys. Stay in touch with me. Stay close. This is how you get good. There is something that happens through osmosis when you stay close to people who do what you want to do. Do you understand? All right, guys. I love you to death. Ciao for now. Enjoy your weekend. Boom, boom, boom. All right.